Hi, hello, namaste. I am Gaurav Malhotra, the co-founder and chief business officer at the Capbook. It's an absolute pleasure to have you all here today with us. At Capbook, our mission is simple. We are helping investors to make informed decisions by bringing in fresh ideas, deep research, and differentiated strategies from some of the India's best fund managers. Today's session is part of our ongoing webinar series where we'll try to simplify and demystify the alternate investment opportunities and to present one of the most compelling opportunities in all market scenarios. Now, the theme for today is mega opportunities in microcap stocks. Our theme is exciting. Microcap is a space where I think it is mostly overlooked by the traditional investors and large fund, but there are certain hidden monopolies in this microcap space, which I think with the right research and conviction of the fund manager, they'll be able to outsize. The returns are going to be outsizing and improving the overall portfolio return. But the main challenge would be how do we identify those microcap? And that's where the professional fund manager experience becomes very crucial. To guide us today through this fascinating world of microcaps, we are delighted to have our speaker for today, Mr. Siddharth Rastogi. He is the Principal Officer, Managing Director, and Chief Operating Officer at Ambit Asset Managers. Siddharth brings well over 22 years of experience in the financial markets. He is a celebrated columnist, a distinguished speaker at various top institutes in India. And he's also author of two books, one of which is 100x Formula, and second one is 8-Minute Decision. So Siddharth and his team is well renowned for their rigorous process-driven approach to meticulously identify monopoly-like businesses in the microcap universe. Today, Mr. Rastogi is going to share his perspective on why microcap matters and how professional fund managers like Ambit and his team identify those opportunities and build a conviction portfolio. Presentation will run for about 30 minutes. You will have option to, and we love to have questions. So please drop in your questions in the chat box. We'll be able to take them after the presentation is over. With that, let me extend warm welcome to Mr. Siddharth, who is with us. Thank you, Mr. Siddharth, for being with us today. Stage is all yours.
Thank you, Gaurav. Wonderful to be with you and with your clients and your loved ones. So let me give you a perspective on first what is microcap, because everybody, as soon as one thinks of microcap, our thinking hats typically go towards well, SME. Sometimes it goes to penny stocks, and sometimes people start thinking that, hey, is it Z group category stocks? So when we talk about microcap, what are we essentially talking? So let me give you an anecdote here. Mutual fund industry officially started in 1993, and since then it has grown robustly. But the first 7 years were rather muted. So almost it took 7 years for the mutual fund industry to grow from zero, almost negligible amount, to 1 lakh crore. However, that industry, the mutual fund industry in India, from 2000 to next 20 years became 30x. तो अगले 20 वर्षों में 2000 से 2020 के बीच में 1 लाख करोड़ वाली AUM वाली म्यूचुअल फंड इंडस्ट्री 30 लाख करोड़ तक बढ़ती है। उसके बाद ये गति चलती रहती है। दिस वेलोसिटी एंड द स्पीड ऑफ AUM राइज इन म्यूचुअल फंड इंडस्ट्री goes to an unprecedented extent. So between 2020 and 2024 December, the mutual fund industry जो हमने 7 सालों में 1 लाख करोड़ कलेक्ट किया, अगले 20 वर्षों में 30 लाख करोड़ कलेक्ट किया, अगले 4 वर्षों में in next 4 years the AUM rise would be 37 lakh crores. That's the kind of quantum one has seen in mutual fund. But why am I talking about mutual fund? यहाँ तो हमें micro cap की बात करनी है. There is a direct connection. What I am talking and what is the micro caps impact on it. तो इतना सारा पैसा आया, लेकिन ये पैसा ज्यादातर कहां जाता है? इक्विटी में. कौन से इक्विटी में? Which kind of equity? Generally segmented equity. What do you mean by segmented equity? SEBI came out with this regulation in 2018 and then they segregated. They said large cap means 100, top 100 companies, next 150 mid cap, and next 250 to 350 small cap. When so much money is coming, it is only chasing 500, 550, 600 odd companies. However, the conundrum is that in Bombay Stock Exchange, you have in excess of 6,500 listed companies. On National Stock Exchange, you have got companies which are in excess of 4,400. But this money is only chasing the top guns. Because of which the P's expand, and because of which the opportunity lies where people are not looking. तो मैं थोड़ा सा आपको इसको एक प्रेजेंटेशन के माध्यम से भी मैं प्रयास करता हूं कुछ समझाने का. मैं एक छोटी सी आपको एक प्रेजेंटेशन, तो जहां पे लोग बात करते हैं कि लार्ज कैप मिड कैप, तो अगर मैं देखूं तो पिछले लगभग 20 वर्षों में निफ्टी ने, अगर आपने 1 करोड़ रुपया इन्वेस्ट किया होता तो 1 करोड़ आपका 10 करोड़ बन जाता. सामने अगर आपने BSE 500 में किया होता तो वो 1 करोड़ का 12 करोड़ हुआ होता 20 वर्षों में. निफ्टी स्मॉल कैप में 14 करोड़, जबकि निफ्टी माइक्रो कैप में इट वुड हैव बीन nearly 19 to 20 odd crores. So this is the opportunity we are talking about. लोगों को लगता है कि माइक्रो कैप में रिस्क बहुत ज्यादा है. That's not the case. In fact, the beta over longer periods of time in micro cap is far lesser. Liquidity is people believe that liquidity is a challenge. So, Gaurav, is it all right if we, rather than having this monologue, if we can have a conversation? तो थोड़ा सा
Yes.
वरना
I think yes, that will be more useful, Mr. Siddharth. So I think we can just directly come to the point that now, since people understand what microcap is, what is the universe, if we can understand what are the key criteria which you use to identify these opportunities from the whole listed universe.
Sure. So this is the most relevant question what you asked, Gaurav. Very, very simply, if I have to put in perspective, in micro cap, what are we talking? as I mentioned, BSE has roughly around 6,500 companies. If I exclude the SME, if I exclude the Z group, if I exclude the anything which is penny. After doing all this, I'm left with closer to 6,000 companies, and I'm not going to the bottom, neither I'm going to the top where everybody has a perspective. What I'm doing, I'm just putting down to the next level, which is 500 first company to 1500 company. So I pick up the raw data of these 1,000 companies and I start working on them. On these 1,000 companies, as you asked, the filter is fairly simple. It's 5-legged filter. Number one, the first criteria is to survive. How do you survive? If you have less debt. Debt is one of the key reasons why businesses cease to exist. So debt to equity, which is less than 0.15. So negligible amount of debt. Number two, pick up businesses which are ethical, which have a good and clean matrix. What is good and clean? Good and clean is a simple philosophy where we try and pick up businesses which do not cook their books of accounts, which are ethical in nature, and businesses which report their numbers cleanly. Plus, they have good corporate governance, integrity, highest value in terms of ethics, in terms of execution, low leakage from the system. Number three criteria is trading volumes. So we generally pick up companies which have a trading volume of 5 to 8 crores for last 6 months on a daily basis. Number four, pick up companies which are monopoly in nature or oligopolistic in nature. What is meant by oligopolistic? Marketplace which is not very, very competitive, which is 2 or 3 large players, and we pick up guy who's the market leader or challenger. Now, why is it so? Because in a consolidated market, if you have monopoly or monopolistic control, then you are able to maintain your margins during tougher times as well. And then the last, businesses where the promoter's skin is in the game, promoter ownership is in excess of 60 to 65%. In some cases, as high as 75%. So the idea is fairly simple. Pick up robust businesses with these criteria out of those 1,000 companies and then pick the best.
Fair enough. I think you explained the criteria quite well elaboratively. But we also understand the risk involved are little higher when we compare it with large caps and mid caps. So what are the risk mitigation practices or procedures which are performed by the fund manager while doing this whole portfolio construction?
Sure. So very, very interesting. Again, very, very interesting question, Gaurav. So you have to remember that there are two kinds of risk in the market. One is a systemic risk and one is a asystemic risk. What is meant by the systemic risk? Systemic risk is the market risk. Risk which can only be diffused if you get out of the market or you invest into asset classes which are uncorrelated to the equity markets. Hence, broadly, you cannot eliminate if your only asset class is equities. And hence, clients approach experts like yourself for asset allocation. So systemic risk is something which very difficult to eliminate from the equity fund management perspective. But on the asystemic risk, what do we do? Number one, the first thing which we do is, as I mentioned earlier in the conversation, that debt is one of the reasons why the challenges happen. You remove the debt from the equations, the chance of death of a company reduces significantly. Number two, the weightages of each stock. Now, there are again 2-3 criteria. Now, number one, we don't allocate initial weight of more than 4 to 5% in a single company, which essentially means that the portfolio is very well diversified. Number two, we do not intend or we do not end up buying companies' equity more than 1%. So we'll always be less than 1% shareholder, because we don't want ourselves the stock to be high or brought down when we are entering or exiting a stock. So that is the number two thing. Number three thing, we spoke about the debt. Number four thing, when the promoter or the ownership structure is in a manner where his large part of the wealth is in the business and he owns majority of the company, significantly large portion of the company, the chance of for him to do dubious transactions is far less. So this is the way we try and mitigate the risk. However, there are quite a few other risks. One is the liquidity risk, because whenever the market temperament would be weak, we saw recently when Operation Sindoor happened, we saw when FIIs were selling, we saw whenever there is a global challenge, the crack in the marketplace happens in the equity markets. First the large cap cracks, and then subsequently everybody else also follows suit. Now in here, micro cap may also correct significantly. Why? Because the institutional holding is low. Now, institutional holding being low is a benefit as well as it's a boon. It's a boon as well as it's a bane. Why? The benefit is these are undiscovered names, undiscovered stories, undiscovered businesses, though doing very well at their own respective marketplace. So you have an opportunity to find great businesses, good companies at a reasonable valuation. Second, the challenge, this is the benefit. But what is the bane here? Since there are no institutions and the institutional ownership is as low as 2%, whenever anyone sells significant stock, automatically the price corrects. So whenever any investor is investing in a micro cap, one has to be cognizant of very simple aspect, that you are buying the business for the fundamental reasons, not for the extraneous reasons. And if you have this kind of clear understanding, automatically there will be growth in the companies.
So that leads, thanks, Siddharth. That leads me to another question: that what is the average holding period of the portfolio, and how long do we see company to become monopoly, to kind of get those price targets which we are expecting from them?
So there are two. So Gaurav, your question actually has two parts. Number one is monopoly, and second is your price target, and third is the exit strategy. So number one, these companies are already monopolistic in nature. We don't anticipate them to become monopoly, and that's when the value unlocking will happen. That's not the case.
Okay.
I'll give you a very simple example. Imagine we all understand the automobile business. Imagine there is a four-wheeler. So we have large number of four-wheeler companies. You have got Hyundai, you have got Maruti, you have got Mahindras, you have got Tata Motors, so on and so forth. If tomorrow a company decides to set up a commercial vehicle or a passenger vehicle segment, and they want to set up their own brand, create infrastructure, put capital, and after all this create a distribution network and then the dealer network, and then market it. It's a humongous expense. On the other side, can I manufacture a very important component of passenger vehicle, without which the passenger vehicle cannot come on the road. So let me ask you a question, Gaurav. Since you asked this very pertinent question, what is the most important thing? What is
I
the
would
most
think a tire or maybe the ignition system.
Okay.
Just out of curiosity.
So from the car's perspective, you're bang on, it's the engine. But from Gaurav's perspective, or from Siddharth's perspective, the most important component in a car is the shoe brake. Can a company make shoe brake for Maruti, for Hyundai, for Tata Motors, for Renault, for Skoda? The answer is absolutely yes. Without the product, the end product cannot, without the B2B product, the B2C product cannot come into the marketplace, number one. Number two, you, in a fragmented market, you cannot succeed, but this market automatically is consolidated. Because you need a particular quality, you need a particular level of service, and you need a particular level of in terms of Six Sigma, in terms of your checks and balances, it needs a certain level of class. Now, if you are manufacturing this, automatically you are relevant. So coming back to our conversation, so you had very three simple questions. Number one is, when do we have a so these are already existing monopoly companies. So that's the first question. The second question is, when do we exit these companies? Very simple. The way we do research is not only from the numbers. We do ground level constant channel checks. So imagine if there is any company which is dependent on exports, significantly exports, and because of the Trump tariffs and because of the geopolitical challenges, it can get impacted. Am I going to wait for things to happen? No. Irrespective of my target, irrespective of my price, I would exit that. Because if I see headwinds hitting, I would exit. Number two, if the company starts leveraging all of a sudden without capex, it's not capex, it's for opex, they start raising tons of money. It breaches our thesis, we will exit. Number three, if this company which to us looks clean, good, growing at a consistent rate of 25-30 odd % PAT growth, Y on Y, it's fine. If it is not, I'm gonna trip. If the PAT growth shrinks down to single digit or lower, I will exit. Next, for me, the price target is, as long as I am getting delivered PAT growth of between 25% to 35%, I'm gonna stay invested. And my typical time horizon on the company is from 36 months to 60 odd months. Can I trim it earlier? The answer is absolutely yes. Can I trim it in 6 months, 12 months? The answer is yes. But my endeavor is to pick up businesses for at least 36 months to 60 odd months.
I think that's reasonable, good time for company to perform, and so that's well understood. Now there's a question from Mr. Ashish that since the market is illiquid, how do we find? I mean, do we face any challenges in exiting stocks when we want to, and will there be a pricing pressure?
Sure. So again, very interesting. So I won't look at only from the exit perspective. I will try and answer on both, because the liquidity is a constraint on both the sides when I enter into a stock as well as when I exit from a stock. And Ashish is absolutely right. Since the promoter ownership is very, very high, promoter ownership is as high as 60-65%, as well as there is a challenge that in case the institutional ownership, which is 2.5%, there are not too many buyers if anyone wants to exit. And if an HNI wants to dump significant stock, then there's a problem. So what do? Whenever we want to buy something, we approach the promoters. We approach the promoters because we have to only buy how much? 0.3, 0.2%. And we tell them that, hey, look, we believe in your company. We believe that you are doing good work. If you want to pair off some of your very small percentage of your holding, so we can do a transaction, we can do a block deal directly from the promoters. So that's number one way. Number two way, we obviously, since Ambit is known for its institutional equities, as well as we have good institutional brokers who service us. If anyone brings us the block of the company we like, we are happy to buy them. So we generally buy businesses in block rather than picking up in the marketplace. So that's number one from the entry perspective. From the exit perspective, until as there is a chaos, when I say, when we have met with an accident, what do you mean by an accident? Accident is fairly simple. If any untoward thing happens, something I explained to you in terms of trade wars, and this company is an export oriented, then I have to sell slowly and steadily into the marketplace. Otherwise, what do? As the company continues to grow, imagine a 790th company. We spoke about that 501st company to 1500 company. That's where the micro cap lies. Imagine you have picked up 790th company. Over next 3 years, the compounding of the company happens at the rate of 30-odd%, which means in 3 years, the company's PAT has actually doubled. If the PAT has doubled, this 790th company may have become 480th company, 480. So if it has become the 480th company, can it come into the radar of the mutual funds? The answer is obviously yes. So my exit would automatically become the fodder for the small cap. And we spoke about it, that the gush of money which is now coming in the mutual fund is predominantly being led by mid and small cap till about 6-7 months back. We saw that in 2021, the total AUM size of the mid and small cap pure funds was merely 1.6 lakh crores. As of January 31st, 2025, that number stood at 6.8 lakh crores. In a matter of merely 4 odd years, it has become 5x, roughly around 4 to 5x. So whenever we exit a high quality company, though we haven't exited too many because our companies are still growing, but we can see the keen interest. One of our company exactly has done this, what I stated. It was a micro cap. Now it has moved into the small cap bucket. As soon as it has become into the small cap bucket, 2 to 3 large mutual fund houses have entered into that company.
Understood. So, very recent topic. How does macro factors affect these companies? So recently, today we have seen interest rate cut and CRR also being decreased by 100 basis, and even the inflation. So, what impact does this macro factors have on these smaller companies? If you can enlighten us.
So Gaurav, I spoke about 2-3 very interesting things. Number one is that these are the companies which are monopoly in nature. These are the companies which have no debt on their balance sheet. And these are the companies which have pricing power, because their products are essential for the execution of a large B2C company, right? Having said so, when the macro environment is conducive, what we saw, 50 basis and a 100 basis cut of the CRR and the 50 basis cut in the repo, clearly there will be demand pickup in the B2C segment, monopoly businesses, but in a large cap companies. Whenever there is a pickup there, automatically the demand for their products, smaller yet relevant, will get enhanced. So that is number one benefit. So whenever the broader economy will do well, these companies will do extremely well. Number one. Number two, though Ambit micro cap is not levered, which means that the companies in the Ambit micro marvels do not have leverage. That does not mean that the micro cap segment does not have leverage. So if other companies have leverage, and when the interest rate cut happens, they benefit directly in terms of PAT, because any cut in interest rate benefits their PAT significantly. Now, if their PAT jumps, if their profit after tax jumps, automatically the earnings growth looks improved in these other micro cap companies beyond micro malls to a large extent, which means investors' interest in the micro cap segment enhances. When investors' interest enhances, automatically there is a rub-on effect. There's a rub-on effect on the high quality micro caps as well, and we benefit. So that's the second benefit. The third benefit of a so the third benefit for the conducive macro is that whenever there is a demand pickup, and demand pickup because of the underlying A, sentiment, B, income enhancement, the companies which are in the micro cap space, when they have significant demand, their efficiencies and economies of scale kick in. Because remember, as the sales volume grows, the cost of goods sold and the cost of production does not incrementally or proportionately enhances. The cost enhancement and is always lesser as compared to the sales growth, if it is a robust job. So that will improve the margins, and that will improve the PAT as well. So in a nutshell, a conducive macro environment benefits tremendously microcap.
Understood. Siddharth, one more thing. So, are there any sector themes which we are leveraging within the micro cap space? If you can just throw some light on that.
Sure. So relevant question again, Gaurav. The themes which emerge from the microcap space, as I mentioned, will be always B2B businesses. So what we see, 55 to 60% of the businesses which arise in the space are actually manufacturing oriented. Number two, businesses which are led by pharmaceuticals, chemicals, specialty packaging. These are some of the factors, some of the themes which come as prominent. There are some of the some logistics businesses as well. However, in a nutshell, what we see is very little in BFSI, because generally BFSI is very, very large businesses. Smaller BFSI businesses always have the threat of perishability. So we stay away from them. So the themes which you'll see is pharmaceuticals, manufacturing, chemicals, etc. from the broader perspective. And it's not that we purposely pick up, it is what comes as the outcome rather than our designed process.
Understood. Just one question on someone is trying to ask. Just one question, Siddharth, out of curiosity, because see, we are trying to build a high conviction micro cap portfolio, and definitely, I think because of the concentration, of course, we'll be having diversification also, but there'll always be this. I mean, your team has to be highly convinced, or conviction. There has to be a high conviction on allocating a significant portion of the capital into a particular company. So how does that conviction get built? If you can just elaborate more on that.
So I spoke about 5 initial processes with which we screen out of 1,000 companies, right? Now, when we put those 5 framework filters, we are left with roughly around 55 to 60 odd businesses. That's when the team actually starts to work. So whatever it has done till now was sitting in office. Now is the time to step out. And this next 5 filters are very, very critical. So the first thing which we do is we go and meet the suppliers ecosystem, the company's supplier ecosystem. There the understanding is we are betting on a very simple factor, PAT growth, right? Consistent PAT growth, profit after tax growth. If the PAT growth has to be robust, sales has to be robust. And if the sales has to be robust, automatically cost of goods sold will also enhance. What if demand is there and my supplier is not thick with me? There are challenges with the supplier. Then, so I need to understand the relations between the suppliers, and I need to understand the relations between the suppliers and the company, payment terms, regularity of payment, etc. Next thing which I would want to understand from the which we do the groundwork is to understand the entire supply chain, the distributor, the wholesaler, the retailer. How's the demand actually on the ground for the product? The next level of check which comes to build conviction is to figure out the processes. How do we figure out the processes? Because in our mind, processes is a single reason why the stock price grows. Capital creates physical resources and human resources. Human resources work on the physical resource, but in parallel, they create efficient processes. Processes lead to scale, scale leads to growth, growth leads to market cap. Very, very simple. So, how do we assess that? By meeting some of the senior management ex-employees of the firm. They tell us what worked, what didn't work, how soon they exited the company, what's the culture of the company. Then we meet the board and then we meet the management, and that's how our conviction is built. And you are right. The reason why lot more fund managers, investment managers don't invest into this segment because it's a lot of legwork, it's a lot of hard work.
I think, yeah, I understood that. More of qualitative than looking at numbers and quantities. Okay, I think I'll move on to my next question, which is how frequently do we review and rebalance our portfolio? Basically, the churning within the portfolio.
So, for us, we review the companies on an ongoing basis. So our analyst team keeps tracking all the news and all the primary information digging from the channel checks on a constant basis. So review is not a static thing. It's an ongoing thing. It doesn't happen like every quarter or every 6 months. Review is an ongoing thing. And that's when the trimming or addition happens on an ongoing basis. The churn in the portfolio, initially, it will be lower. It will be 15-20%, not more than that. But as time passes over next 3-5 years, once the business is mature, the churn can be relatively higher. It can go as 30-35%. Depending on which place we are on the economic cycle, we would take action. So it's not that if I say 15%, 20% now, it will be the same in 4th year. Or if today is 35%, it does not mean that after the 2nd year it will be higher. So everything is relative. For us, it's critical not to meet any accident. For us, growth is going to come because these companies are growing with a PAT of closer to 25-35%. Y on Y. Year on year, 25% to 35%. So there's no question of not growth. The question is clean, consistent growth with no hiccups, no fallouts. That's the endeavor.
Okay, understood. There's another question. Is there an ideal maximum size of the portfolio? Because the category itself is micro cap. Are there enough opportunity?
So we believe that there are enough opportunities. However, we will cap the size of our existing micro cap PMS to 500 crores. So we have currently raised 350 odd crores, another 150 crores, and we will cap it up because we believe that with 25 odd companies, will be good with 20 to 25 crores of exposure in a single company. Number one. Number two, if the average market cap of a company is 2000 crores, and if the promoter equity is 70%, you are left with 600 crores of free float. Out of 600 crores, if we own 20 crores, we are talking about roughly around 0.3%, 0.33, one third of 1%. So 0.3, 0.35% of equity ownership. We are all right. We are comfortable. As I mentioned, we don't want to go beyond 1% in any of the ownership. So that's the math which we have done.
Thanks, Siddharth. There's another question coming up on what should be investors' expected return in this portfolio. I know this is a tricky question, but yeah, of course, this is something which is in everyone's mind while evaluating options.
Sure. So Gaurav, let me put it this way. We believe that, so since I'm also the principal officer, I can't talk about the returns, etc. And I don't have the permission to give you any indicative or futuristic returns composition. However, I'll try and answer this in a different manner. Our anticipation, so we believe very simple thing. Returns have two components, P expansion and EPS. These are the only two things. Every return component has a mixture of these two, EPS and P. We are saying that at reasonable P, we are only believing, or we only want to experience PAT growth returns. We don't want any returns from the P multiple expansion. At the same time, since these companies are relatively high in quality, we anticipate, and also there is an interest rate cut regime which is happening, the chance of P shrinkage is lower. So we believe a steady state of P multiples for next 3 to 5 years. On the EPS, we anticipate growth between 25% to 30% Y on Y. So we anticipate between 3 to 3.5 years, or maximum in 4 years, the PAT of the company should double. Now, you can imagine if a company's PAT is 100 crores, and if the market cap is 2000 crores, and if the PAT becomes 200 crores after 4 years, what should be the market cap? It's a very simple logical math. So what we are trying to do is, rather than finding the outcome, we are focusing on the input, which is find great businesses with relatively higher probability of relatively high growth companies. That's it.
All right, Siddharth. I think that's very nice way to kind of, in fact, I would expect investors also to, when they look at direct stock investing, I think that should be the way how a fund manager thinks and invests. One last question from my side, which is personal. I would like to understand, have you invested your own capital in this fund, and how much Ambit is invested into this fund? You would like to understand.
So as an entity, generally what do we do is, out of this 350 odd crores, maybe 6 to 7% would be invested by the top personnel. So I'm not the only senior guy here. all of us put together, the fund managers, the other senior management along with me, all of us put together along with the Ambit group, and because Ambit is a large group, Ambit has 5-6 verticals, all of them put together, we would be owning closer to 5 to 6% of the entire fund. So that's where we are. Also, another interesting thing is in this, Gaurav, is the fee structure. The way we are trying to make money out of this, because obviously we are not working free of cost. The way we are going to make money is when we give a threshold return to the investor within a specified period, then only I would end up making variable returns. Then only I would be able to earn variable fees, performance-driven fees. If I falter, if I breach on it, if I'm not able to deliver within the specified time frame, within the specified target, I'm not going to make money. So I'm putting all my interest in the scheme, in the fund, in the strategy to do what it is expected to do. If not only the clients will suffer, I will be a bigger sufferer.
So great. I think nice conversation. Any closing remarks before I conclude, Siddharth? You want to highlight not just about microcap, even generally across how Ambit kind of looks at opportunity and what is kind of something you want to kind of.
Sure. So
Then to
there
us.
are three things I would want to conclude the conversation with. Number one, in a regime across the world where things are changing so fast, where nothing is secure, nothing is guaranteed. Listed equity is the simplest and the easiest way to multiply your wealth. So you may be born poor, you may be born rich, you may be born illiterate, you may be born highly educated in a highly educated family. It doesn't matter. If you invest in the right listed equities, one thing is guaranteed, that you're not going to die poor. And today, listed equity investing is not an option, but a compulsion. Because there is no other asset class, at least in country as well as outside, unless you go into the junk bonds, which will give you positive double-digit returns post-tax, post-inflation. Double-digit post-tax, post-inflation. The only thing which can give you is listed equities. So you have to be in listed equities, number one. You are at the sweetest place in the entire universe, in the entire world, to be in India and to be investing in India, because India is the most resilient country in the world. There are 3 Ds which in last 11 years have changed the way the country works. Number one is democratization of capital. The excess of capital, the cost of capital, and the startup entrepreneurial capital, everything has been democratized. Number two, there has been demographic dividend, which India is going to yield till 2057. China's demographic dividend is going to get over in 2033. Japan's got over in 91, and we all know what happened. China, in a decade, you will not recognize what China is today. And India is just starting its demographic dividend. So that's the second. The third is decoupling of India with the rest of the world. There was a scenario when Indian interest rates were absolutely dependent on the world. Today, and I'll give you a simple example of it. In 2019, the US home loan rates were around 2.9 to 3.2%. Today, the US home loan rates are at 7%. 2019, the Indian home loan rates were at 7.8, 7.9%. Today, the Indian home loan rates are at 8.1%. How much have they jumped? 5%. 3%. How much US interest rates have jumped? Almost 100%. Remember, India has cut the interest rates, US hasn't. We are absolutely decoupled. So the point I'm trying to make is India's base foundation has found a different growth trajectory. So listed equities, India story, that is number 2. Number 3, Ambit investment style. So one thing is certain, in equities you will make money, listed equities. In Indian listed equities you will make money. But what is the problem? There are enough crooks and thieves. So you have to be very careful of the pickpocketers. So what does Ambit style do? It gives you growth, but enables you to find good and clean companies. So what should you do? Drive a Ferrari. Surely drive a Ferrari, but not with a single seat bed, with double seat bed. And that's what we are trying to do at Ambit. That's what we are trying to do at Ambit Micro Marvels portfolio.
Thanks, Siddharth. I think quite insightful information all along the presentation from your side. And I would actually thank you to have shown us how investment works from your side. And I'm sure our audience and guests would have enjoyed listening to you. And so I'll just conclude. So our Capbook, our mission is also to help investors make informed decisions. We provide access to these innovative and well-researched strategies. And if anyone would like to learn more about microcap, whether they fit into their investment plans or would like to have their broader portfolio kind of reviewed, whether they aligns with their investment goals, they can feel free to come to us and reach out to us directly. Once again, big thanks to Mr. Siddharth Rastogi and the team at Ambit to have partnered with us to make this presentation fruitful today. Thank you all for joining in and having shared your questions. Wish you a great evening ahead and a happy weekend. And look forward to welcoming you again in our next session very soon. Namaste.
Thank you, Gaurav.
Jai Hind.
Namaste.
Thank you.